Good evening. This is Ken Law from Tortoise Capital with a coaching lesson about what we're calling chain framing, or linking together modules of measured moves and trade patterns that are sequenced in creating a logic chain that takes us through the day as we develop insights about our targets and the kind of day it's becoming. So in the chat room, James has posted a couple case studies. One is a hybrid frog from March 10th, 2016, and he gets 1.5 R on this one, and then about a half an R on a caterpillar trade. And so what I asked him to do is to prepare a sketch that looks like a chain that shows how these things might link together, and to give him an idea of what it is that I mean so that you can start getting this idea nailed down. Start with the trade frame in Alcoa. So he starts off with a hybrid frog at the open. He has his frog box up, frog box down. It moves to the downside, so he takes the auto entry short. It moves outside of Z-3. He cashes a quick hit for 1.5 R in about 6 minutes. This is on 2-minute charts. And then we observe this reversion back to the mean, or back to the opening and beyond. This actually goes to the far side of the river. And so what we've got to do is take these trades when we get them, and then immediately be ready for the next chain. When it gets down to this critical state at Z-3, one of two things is going to happen. It's either going to collapse further, and if so, we want to have a second position on, because the measured move from open to Z-3, that's one leg, and we would expect to see another leg of similar magnitude moving down. Or it's going to rebound, and we know it can move this far because it just moved that far. And so we're going to look at the far side of the river and the low of the day and say that that is our opportunity. And if we can get this as a 1, 2, 3 entry, when price and the 10-period regression line get into the dragon, then maybe I can make this move. And the yellow dot signifies that if we're able to see price get beyond the hump in the dragon right here, above yesterday's closing resistance, then the size of this move from here to here is leg 1, and then we would see another leg of similar magnitude on the way up, and that's where we would have 2R in hand, and we'd want to add a second position with momentum. And so, looking at the same kind of idea in Caterpillar, he gets the hybrid frog entry here. He maybe trimmed it a little bit short, but it went ahead and moved all the way down beyond Z-3. So when we get the reversion in pattern 7 from a Z-3, and we target the far side of the river, or in this case the VWAP, or the Bollinger Band mean, we can now say, what is the minimum manageable risk box that I can manage off the bottom? In this case, it's a 1, 2, 3 entry, and I can go from Z-2 to Z-3, and if my entry can be in here, then this is my risk box. If it fails, if this trade on the long side fails and drops out of this risk box, I'm going to be stopping and reversing, because the size of this leg down is the size of the next leg down. But if it works, I would not be surprised if it gets back to the VWAP, which is what it's supposed to do. So now my reward looks like, from the moment of entry off a 1, 2, 3, up to the VWAP, and if this is my minimum manageable risk box, which I get paid to know, minimum manageable risk box is that risk at which I don't take more than a 1R loss. That means I can identify a risk and then manage to it without exceeding those parameters. That's the definition of a minimum manageable risk box. So if this is that risk box, in this case it's the distance between Z-3 and Z-2, that's how big that box is, I've clearly got 1, 2, 3 units of reward just to get back to the VWAP. And now what we can also say is that the 10-period regression line that moves all the way down here is the proxy for price. That's how far traders can move price in the short term away from the VWAP, the volume weighted average price. And so by applying a little logic here, would say if they can move it from the VWAP to this far, they can also move it to the VWAP and beyond a similar distance. So if we call that leg 1, if it gets through the VWAP with a couple R in hand, that's where we want to add a second position on the chance that it might make a second move of similar magnitude to leg 1. So that's what we mean by a chain trade, that we're going to see something at a critical state and then realize the next module is either a reversion to the mean or the VWAP or the far side of the Bollinger Band or a retest of the high of the day, or it's going to be a second leg continuation pattern to the downside. So we have the hybrid frog module to get us in, so we don't have to think so much. Second one is responding to a trade location at a critical state where it's either going to rebound or collapse further. The worst thing that happens is if we put that bracket trade on and it goes sideways, and this ends up becoming a sideways quiet channel. But given the vigorousness of the move, the probability that it runs immediately and decisively to precisely the new fair value where it goes sideways quiet channel like here, pretty small. And even if we're wrong, we don't lose any money on that one. The trade never fires. So the chain trade then is when is the mental and technical preparation so that when one module is over, you're ready to go to the next leg of the chain and continue your trade framing, in this case using a new pattern, not the hybrid frog, but you're using the RLCO patterns and the regression line fractal framework, and in some cases frog boxes, to make these measured moves and define reward and risk in those terms. So that's what we mean by chain framing. This is Ken Long at Tortoise Capital. Keep your risk measured and your powder dry.